Hi, my name is Matt Campione. I'm a partner at the firm of Small & Plevy. My principal area of expertise is federal tax law, and today I would like to discuss the tax issues related to the Bernie Madoff scandal and other Ponzi schemes. Putting it in perspective, the Bernie Madoff Ponzi scheme may have cost investors upwards of $60 billion. It's not the only Ponzi scheme that's been uncovered in the last few years in the United States. So there are a lot of investors, not just the Madoff investors, that have been victimized by such schemes. How many people, year in and year out, get information returns from their brokers and their investment advisors that show interest income, dividend income gains, that they do not question that these are accurate presentations of their share of income, and they let it ride with their investor. They do not take it out. They just assume it's part of their accumulation of their wealth. So I would not beat up the investors for that they did something they should have done differently. A lot of these investors are truly victims. Maybe many of them could look back now and see about some bells and whistles that may have reduced the possibility of the damage that they incurred. There are some who also say that the government has something to do with it, in that they did not truly look more closely at somebody like Bernie Madoff when several times there were questions about how he was conducting his business. The typical arrangement would be, let's say, I'll use a simple example. You put in $100,000 with an investment advisor and manager of funds that turns out not to be legitimate. During a period of time, the actual investment advisors is sending you reports and tax information returns that says you're doing really good and you've already earned $100,000. So now you have $200,000 as far as you know, okay? And then you see the bad news on evening news that that person has been doing a Ponzi scheme, which means that there are not even assets that are identifiable related to your money. So from a tax point of view, you have a $200,000 cost in what you've done with this person. You have the 100 you put in and the 100 of investment that you've accounted for on your tax returns and paid tax on. The government, as a general rule, will allow you to deduct that $200,000 as a theft loss in the year it's discovered. For many people, like with Bernie Madoff, it will be 2008. And basically you can use it against ordinary income for the year and carry it back to the extent there's a net operating loss because it exceeds current year income. That's a very general statement. There are some fine-tuning to the example I just gave you. But generally, what you put in and what you reported as income is the core to your theft loss deduction. The consequences will depend greatly on the condition of the particular investor. No investor is going to get 100% recovery through the tax law. The best they can get is a percentage of the deduction. So if you're in the highest marginal rate, for federal tax purposes, you may only get back 35 cents on the dollar related to your deduction, which is a far cry from the amount of money you've lost. Clawbacks. These are clawback actions where basically let's say a trustee dealing with the Madoff matter, basically based on different theories and different time frames, tells people you have to return this money. If you had put money in with one of these investors and cumulatively over the years you actually have taken out more money than you put in, you may first start off by saying, wow, isn't this horrible, but I'm lucky. Until you find out that there are other sets of rules that say you may have to return a good portion of that money to be shared with other victims. But you could be among the group that has to return all the profits and perhaps even the original principal you put in. Maybe to put it in perspective as to why this rule or this possibility exists is these issues should not turn on who got there last or left there first. So if you have, let's say, two investors that each put $100,000 in, and just by their individual circumstances, one takes $200,000 out, the other thought he had $200,000 and finds out he has none, the perspective is that some of that $200,000 that was paid to the person who left may be from the very money that the others put in, and therefore it should be part of what's put back in the pot. Well, just by simple math, you could see that if they ended up being equal and there's only $200,000, now the guy who had $200,000 only gets to keep 100, and the other one gets 100, and that's where the battleground is. Now the problem is more extreme. The money that comes back is spread amongst many more investors who got little or nothing. So the person who has to put back $200,000 may only get $20,000 back as a result of that arrangement. And that will be a significant battle probably over the next few years. It's ironic, the victims end up being against each other to some degree. There are arguments that they can go back as much as 6 years, which means that somebody, if Madoff has been dealing with this, in some instances you may have the arguments for clawing back money related to profits that were taken even 6 years ago, if that was during the period of the fraud. Once it's determined that there in fact is a clawback, that they must return some of the money, I would analyze the best tax treatment of having to repay that money. And it may consist of a combination of positions they could take on their tax returns. This is where I think we can be of more significant help to them. The first thing in the primary is you have to exercise whatever defenses you may feel you have, including good faith, that you don't have to return all or some of the money, because the best defense is to keep the money. But it all boils down to the sooner you can get a deduction, the more efficient your return is going to be from a tax point of view in most instances. And the sooner you get a refund, hopefully at the highest marginal rates, that's going to be beneficial. In the most cynical sense, if you have people that must fully prosecute their claim for recovery, they could be in a situation where, based on their costs and what they actually recover, at some point in time, an efficient deduction that gets you 35 cents on the dollar right away, and as early as 2009, for people who were victimized in 2008, may ultimately be fairly attractive. You got 35 cents, including state, you may be getting maybe 45 cents on the dollar returned. And other than being totally mortified and disgusted with what has happened to you, you've gotten that money back. Whereas if you go through a legal process, you may be in a situation where you're not going to be much more efficient than that anyway. I'm Matt Campione, and if you wish to discuss any of these tax issues with me, you can reach me by email at mjcampione@smolenplevy.com. That's MJCAMPIONE at Smolen, SMOLEN, Plevy, PLEVY.com. Or you can call me at 703-790-1900. Thank you.